inflationary pressures continued to abate in December 2011, with headline and core inflation declining 27% and 29%, from 29% and 31% respectively in November 2011. Annual food inflation also declined 34.7% from 40.3% in November 2011. Monthly headline inflation declined to minus 0.4% from 0.13% in November 2011. Monthly headline and core inflation over the last 3 months averaged 0.5% and 0.8% respectively, indicating lower annualized inflation going forward. Annual non-food inflation has, however, remained relatively sticky downwards at about 22.8% for the last 3 consecutive months. There are very clear signs that inflation has peaked, and I now fully expect inflation to continue declining in most of 2012. But of course, prices for goods and services are sticky, and therefore the decline in inflation is expected to be gradual, especially for non-food commodities. The continuous decline in food inflation since October 2011 is an indication that the impact of supply-side shocks to food prices is abating. The stickiness of non-food inflation, on the other hand, is a combination of lagged impact of exchange rate depreciation on prices of imported goods and the temporal impact of seasonal factors on the elasticity of demand for non-food items during the festive season. Global inflation is also falling. It is also forecast to fall during 2012 because of the possibility of a sharp economic deterioration in the developed countries, which will result in the decline in commodity prices, and this will support our anti-inflationary policy stance. Nevertheless, the weak balance of payments and the associated exchange rate depreciation pressures remains a major upside risk to inflation. Furthermore, the continued turbulence and vulnerability of global financial markets would also lead to depreciation pressures as offshore investors in government securities exit the market. Therefore, although inflation has reduced, the challenge of bringing down inflation to an acceptable level on a sustainable basis remains significant. The peaking of inflation and the recent strengthening of the shilling shows that monetary policy is quite effective, and that the Bank of Uganda must maintain a tight stance in order to bring down inflation and stabilize it around the medium-term target of 5%. As expected, this stance has resulted in an increase in the lending rates of banks from a weighted average of 21.7% in July 2011 to 25% in November 2011. However, it must be understood that there are sectoral differences reflecting differences in risks as assessed by banks. Also, lending rates on personal loans increased from 21.7% in July 2011 to 25.7% in November 2011, contrary to what has been reported that personal loans are above 30%. The Bank of Uganda will therefore maintain the central bank rate, CBR, at 23% in January 2012. However, due to the sharp decline in the monetary aggregates and the weakening of economic activity, as reflected in 2011-2012 Q1 GDP growth rate, and the sharp decline in the index of manufacturing output, the band on the CBR will be reduced by 1 percentage point to plus or minus 3 percentage points. The margin on the rediscount rate will therefore be 4 percentage points on the CBR, and the rediscount rate and the bank rate will be 27% and 28% respectively. I acknowledge the fact that the long-term solution to controlling inflation rests squarely on addressing the structural constraints and improving productivity. But controlling inflation in the short to medium term is extremely crucial in stimulating this long-term economic growth. I thank you.
Thank you, Mr.
We tighten monetary policy